Hello, Richard Austin, Managing Partner of Cambridge Partners. These are extraordinary times. It was just 2 weeks ago since we provided you with our latest update, and much has changed since that time. The World Health Organization has now officially declared the coronavirus as a pandemic, and travel bans have been put in place for many countries around the world, including here in New Zealand. The Reserve Bank has now made a cut to the OCR. The rate was 1% and has now been cut down to an all-time low of 0.25%. Governments in both New Zealand and around the world have been putting in place measures to support businesses through these really difficult economic times. While there is much emotion around these issues for all of us, and to be frank, these are times to be worried, it is also really important that we do keep a calm head and try to make sure that we see the reality of what's happening versus our own perception and worry about what is actually going on. Share markets always react to new information that's coming into them. And as the scale of the effects of this virus become more and more known, we've seen a dramatic fall in share market values and prices, particularly over the last 3 weeks. These are large falls in anyone's language, but they need to be put into context. The last 10 years have seen a very strong bull market all around the world, with very, very positive returns from most asset classes. I don't think any of us expected to see the sort of downturn that we've seen over the last 3 weeks, especially one that was initiated by a virus, while everyone was anticipating a more mild correction to the markets. So this has shocked the markets and has come at a time when most people were feeling quite bullish about their investments, about their retirement funds, about their savings. So as we know, markets are driven by two strong emotions, fear and greed. So it's very clear that greed has now been overcome by fear, and that fear of the unknown is driving a lot of investor sentiment and is also driving some of the decisions that people start making around their investments. Our portfolios here at Cambridge Partners are very well diversified over thousands of underlying assets. We have investments all around the world, and we're exposed to countries, sectors, economies and markets globally. New Zealand itself is a small, open economy, and as such, being a net exporter, we will be very vulnerable to the winds of change that are now occurring offshore. So having a portfolio that is well diversified, holding offshore assets, actually does have some advantages. And those advantages can be seen in the fact that we won't necessarily have as hard a landing as the New Zealand economy would have within the portfolios. Our portfolios will be exposed to the first countries that start to recover from the coronavirus, and therefore their financial markets start to recover. As the New Zealand dollar falls, which is something that we've seen recently, that will have a dampening effect on the losses that are being experienced in portfolios, because we are reporting our returns back in New Zealand dollars. In addition to holding a high level of growth assets, we also hold very high quality defensive assets, which also help to diversify and reduce the volatility within our portfolios. Again, we hold those diversified assets both offshore and here in New Zealand. So for example, a 50-50 portfolio is down around 13% from its recent peaks in February, but for the year is now down around 6% for the last 12 months. While these are significant falls and no doubt very concerning for any investor, it's got to be put into context that they are lower falls than the 30% fall in value that we've seen for shares both globally and domestically. So holding this diversified portfolio is a clear and sure way of ensuring that you are able to mitigate some of the large falls in values that portfolios have been seeing. Equity markets react very quickly to new information, so a good place to start is to assume that all known information, whether it's good or bad, is actually priced into the share prices that we're seeing now in the marketplace. So we can then assume that the virus and its impact on economies is now being reflected in the lower pricing that we're seeing in share markets. What we do find over time that as new information comes into the market, shares react. They either go up or they go down. So while we can't predict what tomorrow's news is going to be, what we do know from history is that those investors who react to negative news and sell during those times will always face a loss versus those investors who stick with their strategy and ride out these more difficult times. The difficulty any investor has with deciding to sell is, when do you do that? Do you do the selling when the market is falling, or do you wait till the market's fallen? And then importantly, when do you buy back in? Is that later after you've totally sure that the market has returned to value and maybe you've missed returns that could have been there if you'd stayed invested? So these are really difficult decisions to make, and they generally lead to loss of value and loss of return for an investor. So a sensible strategy is to maintain your holdings in your share portfolio as long as you can and ride out this very low market we're having at the moment. If you are a client of Cambridge Partners, it's well worth remembering that when you put your portfolio together with your advisor, you went through a very robust planning process, and that process looked at your objectives, the sort of portfolio you would need, the sorts of risks that you're willing to take, and how we would mitigate any stress that may happen along the way to your portfolio. Your portfolio investment strategy was actually designed with times like this in mind. The short answer is nobody knows. However, it looks like the next 3 to 5 months are going to be very difficult in terms of world economies, share markets, as this whole level of uncertainty driven by the virus, driven by the fact that people need to be isolated, that travel is now stopping between countries. So it's likely that we will see profit warnings for countries, profit warnings for companies, and general economic bad news filtering through the media. However, at some point things will get better. If we think about it, in the Northern Hemisphere they are starting to enter into their spring and soon to be summer. And that will be good for people who have the virus and those who are wanting to recover from the virus. We all remember the global financial crisis, which started in late 2007. During that time, very much as we are feeling today, we all thought the world was coming to an end, that the financial markets had collapsed and that would never have a recovery. But since then, we've had 12 years of a very, very strong bull market. In fact, a year after the GFC, the world markets recovered and returned 53% on an average portfolio. So sticking to a strategy once again is the right way to go. If you're feeling nervous or concerned, then that's perfectly understandable. The first thing I'd advise you to do is make an appointment with your advisor and come and sit down and talk through your concerns and fears with them. What we do know is that markets will recover at some point. As I said earlier, what we don't know is when will that be. But there are some practical things that you can do in the interim. And I'll just point out a couple of those. The first one would be, if you are taking withdrawals out of your portfolio on a regular basis or now and again, then over the next few months it might pay to reduce those withdrawals, or in fact suspend them for a couple of months while the downturn in the markets are going on, because that way you won't need to access as much capital from your portfolio. Secondly, while it may seem perverse, if there is cash in your portfolio or you're an investor with cash outside your portfolio, these low prices that we're seeing in the markets actually will no doubt represent some really good buying opportunities at some point. In fact, we're looking at rebalancing portfolios on a regular basis, so as their growth assets fall in value, we will be directing some of the fixed interest parts of a portfolio back into growth, so that when that recovery does return, we'll be in a very good position to take advantage of it. Finally, I'd recommend that you sit down with your advisor and review your objectives for you and your family and look at those objectives against your portfolio at the moment, so you can make sure that the portfolio is still structured in a way to help you meet whatever your long-term goals are. We would very much encourage you to not let fear and concern drive your decisions around your investments and making additional investments. This is a time to take a rational approach to your portfolio and to your long-term goals. So again, stay calm, look at the reality of the portfolio, be careful about what media you listen to, and make sure that if you are worried that you do talk to your advisor. Be rest assured that we will keep you updated over the coming weeks about changes in the environment, the investment markets and portfolios.